Have you ever pondered over finding undervalued stocks? Well, if you're intrigued by the dynamic world of the stock market, this topic is of paramount importance. It's like a treasure hunt, where the treasure is an undervalued stock that could potentially yield high returns. But how do we differentiate between an overvalued and an undervalued stock? What parameters should we consider? And how can we spot these hidden gems in the vast expanse of the market? Stay tuned as we delve deeper into the world of undervalued stocks. In the stock market, value is everything. This phrase may sound simple, but it holds a wealth of meaning. Grasping the concept of value in the stock market can be the difference between profitable investments and financial pitfalls. Let's start with overvalued stocks. Essentially, an overvalued stock is one that is trading at a price significantly higher than its intrinsic or true value. This often happens when there's a lot of hype around a particular company or industry. For instance, tech stocks can frequently fall into this category. Investors get excited about the latest gadgets or groundbreaking software, and this enthusiasm can drive up stock prices beyond their actual worth. Think of a balloon being inflated. It expands and expands, but at some point it's stretched too thin and can burst. The same can happen with overvalued stocks. Now, let's shift our focus to undervalued stocks. These are stocks trading at a price lower than their intrinsic value. This can occur for a variety of reasons. Maybe a company had a bad quarter, or there's negative news circulating that's caused a temporary dip in the stock price. However, the key word here is temporary. These stocks are like diamonds in the rough, waiting to be discovered. Once the market corrects itself, the true value of these stocks shines through, and their prices can increase significantly. For example, consider a company that has recently reported lower than expected earnings, causing its stock price to drop. However, upon closer inspection, you find that the company is fundamentally strong, with good management, strong market position, and a solid financial structure. This indicates that the stock might be undervalued and could represent a great buying opportunity. Understanding the difference between overvalued and undervalued stocks is crucial in the world of investing. It's about discerning the hype from the reality, the inflated from the genuine, and the overpriced from the bargains. So, how do we find these hidden gems, these undervalued stocks? Let's explore. Finding undervalued stocks is like finding a needle in a haystack, but fear not, we have the magnet. One of the ways to identify undervalued stocks is by using financial metrics, and the first one that comes to mind is the price to earnings, or PE ratio. This ratio is calculated by dividing a company's current share price by its earnings per share. A low PE ratio could indicate that a company is undervalued, but it's not always that simple. The PE ratio should be compared with other companies within the same industry to get a clearer picture of its value. Another essential metric is the price to book, or PB ratio. This ratio compares a company's market value to its book value, which is the value of the company if it were to be liquidated and all its assets sold off. A PB ratio less than 1 might indicate that the stock is undervalued. However, just like the PE ratio, the PB ratio should also be compared with other companies in the same industry. Now, let's move on to the debt to equity, or DE ratio. This ratio shows the proportion of a company's funding that comes from debt compared to equity. A lower DE ratio often indicates a more financially stable company, which could be undervalued. However, some industries tend to have higher DE ratios than others, so it's crucial to compare this ratio within the same industry as well. And finally, we have the dividend yield. This is the annual dividend payment divided by the market price per share. A high dividend yield could indicate an undervalued stock, but again, it's essential to compare this with other companies in the same industry. So there you have it. These are just a few of the many metrics that can be used to find undervalued stocks. However, it's crucial to remember that these are not foolproof and should be used in conjunction with other research and due diligence. So with these metrics at your fingertips, you're well on your way to finding undervalued stocks. So we've unraveled the mystery of finding undervalued stocks. We've delved into understanding the concept of overvalued and undervalued stocks and why it's crucial for your investment strategy. We've explored how to identify undervalued stocks using parameters like PE ratio, PB ratio, and dividend yield. Remember, it's all about the balance between risk and reward. Now it's your turn to dive into the stock market and find those undervalued stocks. Good luck!